This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. Yes, indeed, this is Bloomberg Businessweek Daily. It is Monday, June 22nd, 2026. Carol Massar, Tim Stenivek, back here on the East Coast.
Yeah, nice 23 hours in Las Vegas and a nice three-day holiday weekend. But we're off and running on this not holiday shortened trading week.
No, indeed. And you've got a market mostly lower here at this hour. You've got Wall Street traders driving stock prices down from the brink of record highs as a slide in several tech giants overshadowed optimism about progress in peace talks between the U.S. and Iran. And I got to be quite honest with you, we're going to kind of try and parse through some of the headlines that have been coming out when it comes to that relationship between the United States and Iran.
Yeah, Jenny Welch from our Bloomberg Economics team is going to be joining us in just a few minutes. Before we get to her, though, we take a look at the iconic and memorable Fed chair, the second longest Fed chief, Alan Greenspan, remembered for many things as he passes away at the age of 100.
Productivity gains, irrational exuberance. So we're going to break it down for you. Plus, JPMorgan Asset Management's multi-asset solutions global strategist is going to talk to us, or we're going to at least ask him about Alan Greenspan. We're going to talk about war, inflation, and political upheaval in the UK. What is the macro on this Monday?
Also, a Bloomberg exclusive when it comes to consumer credit resilience. That a little later this hour on Bloomberg Businessweek Daily.
All right, let's get to the markets and that trade mostly lower on this Monday. For an update, let's get to Matt Piper, who's in for Charlie Pellet.
Hey, Carol, thank you. Stocks, yeah, you're right. They're mixed as oil prices fell on signs of progress and peace talks between Iran and the U.S. continues, with Vice President Vance saying moments ago that they are making progress and, quote, we'll have to keep working on it. The S&P right now is down 0.3%, down 24 points. The Dow is up 0.3, or up 143. The NASDAQ is down just above 1%, down 290 points. The 2-year yield is at 4.22. The 10-year is at 4.50. The flow of oil through the Strait of Hormuz is running at the fastest pace since the Iran war began. That's despite Tehran stating that the waterway is shut. Bloomberg has learned Iran shipped more than 30 million barrels of oil for Asia in the past week. As for oil here, Brent $77 a barrel. WTI is down 2.5% at $74. The Bloomberg Dollar Spot Index sits at 1218. Stocks we are watching: air travel. Looking at budget airline EasyJet overseas. Shares of EasyJet right now are up 2.7%. This after it rejected a third $6.3 billion takeover bid from U.S. investment firm Castlelake. Under that proposal, accepting EasyJet shareholders would have gotten $8 a share in cash, a premium of around 59%. As for airlines here, jet fuel prices have dropped. That has airlines up. Delta right now is up 2.5%. United is up 0.7%. American Air up nearly 3%. Coca-Cola and the IRS will square off in court this week in a case that could cost the beverage giant as much as $20 billion. That's a lot of can of Coke. The despite centers on how much Coca-Cola's foreign affiliates pay the company for the right to use its trademarks, brand names, and that secret formula. The IRS says the affiliates did not pay enough and that Coke's U.S. income and taxes should have been higher. Coca-Cola's shares right now are up 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash.
All right, super, Matt. Thank you so much. Of course, Matt Piper in for Charlie Pellet on this Monday. Well, news today that Alan Greenspan died at the age of 100 due to complications of Parkinson's disease. Now, Greenspan, I mean, the tenure is remarkable on a lot of different levels. He served under 4 presidents. He worked alongside 7 U.S. Treasury secretaries. His tenure, by the way, the second longest for a Fed chief, and it coincided with the steadiest period of economic growth since the central bank's creation in 1913, a 10-year run between a recession that ended in March of 1991 and another that began in March of 2001. I remember 1991. I lost a job then.
It was also an era that gave us the Greenspan put, also the briefcase indicator, and 2 words that have often been repeated.
But how do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions, as they have in Japan over the past decade?
And that, of course, was former Fed Chair Alan Greenspan back in December 5th of 1996 in a speech in Washington, D.C. It was an event put on by AEI, the American Enterprise Institute. Now, irrational exuberance. What?
I wonder if when he uttered those words at the time, he knew that for decades to come, it would become sort of like this classic for him, for us to refer to when talking about certain elements of markets.
And looking at, right, exactly, looking at markets almost to some extent in times that we've gone through recently, because it certainly is part of his lore. It's also, as you mentioned, Tim, kind of part of the overall market and economic lore. We want to get a little bit more on this and on Alan Greenspan, his tenure, someone who's covered the Fed for us here a long time at Bloomberg. We head to Jackson Hole, Wyoming, and to Bloomberg TV and Radio, international economics and policy correspondent Michael Mckee. Hey, Mike, a long tenure, no doubt. He saw a lot, guided the Fed through a lot. What is Alan Greenspan's legacy? Is it those two words, irrational exuberance, or so much more?
Oh, I think it's so much more, although I have to say, I was there at that speech in 1995, if you want to know how long I've been covering the Fed. And I can tell you more about that in a moment. But what I would say about Alan Greenspan is he's probably the most consequential Fed chair that we have ever had. So much happened under him. There were some incredible triumphs and some major errors. The triumphs were the kind of thing that he was noted for in the most of the first 2/3 of his term, shall we say. He stepped in front of the 1987 market crash by promising unlimited liquidity. And then he presided over, as you said, the longest to that point period of economic expansion in the country's history. And he also brought us to a soft landing after the dot-com bubble. But that 1987 intervention was repeated in 1995 when the markets fell, and again in 1998 when long-term capital management got into trouble. And then it became the template for QE under Ben Bernanke and succeeding chairs. So that became known as the Greenspan put. And there's pretty much agreement that that has distorted the markets. He also was too slow to recognize what was going on in the markets in the early aughts when we got into trouble with the housing markets. His monetary policy before that, in the early aughts coming out of the dot-com recession, was to lower rates to 1%, the lowest they'd ever been at that point, and then leave them there for a long time, which then enabled all that subprime lending to grow. And he turned away from warnings that we were going to get into trouble with that. So a lot of things happened under him that were very important. I think irrational exuberance is probably the catchphrase he'll be known for, but not the most important thing that he did. Because at that point, he didn't stop the market. They just kept going up and up and up. And eventually we had the dot-com bubble.
Mike, we'll talk more about markets and bubbles throughout the program today. But before we do that, I'm just curious in your view about the way that he communicated with the public and how that changed over his 18 years. And if we can draw any sort of line between the way that members of the Federal Reserve communicate publicly now and how he communicated to the public.
Well, he changed the Fed entirely. In 1994, he was the first one to put out a statement after the meeting telling the markets what they had done. Up until that time, you had to parse through the money markets and the money supply to figure out what the interest rate was. And every bank employed what were called Fed watchers. He put out the statement, and then a short time later, he made that a permanent feature of the Fed. They expanded the minutes and brought them closer to the date of the meeting. They announced a lot of other programs that they had previously not done before. And they started speaking on television a little bit more. So he definitely opened up the Fed in a way that it never had been until the point where he's there. Now, since then, we've had the development of technology that has also increased the reach of all these speeches. And I think that what Kevin Warsh is worried about in terms of too much speech is more related to that than to Greenspan's initial moves.
Well, we are now in a new era, too, at the Fed, and that is the Kevin Warsh era. Hey, Mike, thank you so much. We always appreciate your perspective and the different Fed chairs and certainly the economic cycles that were the backdrop for each. That, of course, is our Michael Mckee. He's on vacation, but he jumped in.
I was going to say, I'm glad he brought a collared shirt. He's not in Jackson Hole for, the annual Fed symposium.
Not yet.
Not yet. That comes in August. But.
Yeah, exactly.
Yeah.
But jumping on, because he really just has such a valued perspective here at Bloomberg when it comes to Fed chairs and Fed cycles. Hey, our next guest does too, although he was a lot younger, I believe, when Alan Greenspan was there at the Fed. Let's get to David Lebovitz. He is multi-asset solutions global strategist at JPMorgan Asset Management. They've got about $4.2 trillion in assets under management. David here with us on set. Before we get to the macro, tell us about, I think you were in college when Alan Greenspan was wrapping up his tenure as Fed chair. Any recollection, or even as you started at JPMorgan, I think that was in 2010?
So when I think about Greenspan, the thing that I always come back to is that he left his mark on the Federal Reserve. It was very much the Greenspan view as opposed to the view of the Fed. And so, obviously we remember what happened after that, and it was a little bit difficult to find my first job to try to commiserate with you a little bit. But, when I think about Greenspan, he had his agenda. He pushed that onto the Fed. They still made decisions by committee, but he definitely wanted to leave his thumbprint. And I get the impression that Warsh is kind of the same mind. Warsh wants to be seen as the leader of the current Federal Reserve and really kind of drive the decision-making while albeit still respecting the structure of committee.
How does he want to change? Does Kevin Warsh want to change the Fed? Just based on what we heard last week, there are a lot of task forces involved.
So lots of task forces and lots of breaking down problems. But I think two things really come to mind. One is he wants to remove some of that forward guidance, right? He wants to leave a little bit more to the imagination of market participants. Arguably more important is the idea that inflation is going to be priority number one. And if that wasn't made clear by the statement and the presser, I'm not sure how to make it that much clearer. What's interesting about that in the current environment is we're looking at an economy which is effectively at full employment. And so the question to my mind going forward is how does the growth-inflation relationship evolve, and how does Warsh respond to that on a go-forward basis?
Sometimes, David, they say you get the right Fed chair at any given moment in time. Is Kevin Warsh the right Fed chair for where we are and what's coming at investors and maybe big disruptions like AI as that continues to play out in the economy and markets?
So I think I'll leave the historians to determine whether or not he was the right Fed chair when all is said and done. But I do think when I look at the skew of
but based
risks,
on what you've heard from him,
so when I look at the skew of risks in the current environment, I definitely perceive more risk from inflation than risk to the labor market. And so I do think we have somebody who's going to be very focused on what's happening with prices at the helm of the Fed. And I think that's arguably a good thing because as we've seen over the past couple of years, when that inflation genie comes out, it can be difficult to put back in the bottle.
So let's tie in the macro environment with the challenge of inflation right now. Certainly we're seeing oil under pressure today. Maybe there's some optimism about what's happening in the Middle East, but that story can change, as we learned over the weekend, very, very quickly.
Yes.
So if that is the main driver of inflation right now, then what is the task that the Fed chair has in front of us?
So I think that that's actually the wrong thing to be focusing on. I think what the Fed needs to focus on, and I think what the Fed will focus on, is the way things evolve in the labor market. Movements in food prices, movements in energy prices, they come, they go. Only if those price moves are sustained will they really have a broader impact on the economy. If you see the labor market tighten further, you see wage growth begin to reaccelerate, that's what's going to rub the Fed the wrong way, and that's what's going to evoke some sort of response.
Is it possible that, what comes to bite back this administration is the limits on immigration? I mean, how do you grow an economy, right? You have to grow the workforce eventually. I mean, is that going to kind of hurt this economy?
I think that's the biggest risk as it pertains to wage growth. You have structurally reduced the supply of workers that is available that, all things else equal, should push up on wage growth over time. And so the way that you can square the circle, the way that you can thread the needle is you're making a bet on productivity. You're making a bet on the AI
Something
transition.
Greenspan talked an awful lot about.
Exactly, and he got it very much correct. And so what I think we need to watch for, again, is not necessarily what shows up in the productivity statistics. Productivity is effectively a residual, right, that the BEA ends up with after their calculation, but more so what businesses are saying, right? How they're using AI and whether that's flowing through to the bottom line. Because if you can increase the amount of revenue you're generating per employee, that to me is the clearest measure of productivity growth in real time.
Are you seeing evidence of that right now?
I think you're beginning to see some signs of it, but I think that the improvement we've seen in the productivity statistics over the past couple of quarters should not be conflated with what's going on with AI. Still early days
explain
there.
that a little more. So even we've gotten better at measuring it, but don't confuse that with an actual productivity
Well,
increase.
you're just
as a result
beginning,
of
I
this
would
tech.
say that the productivity numbers versus what we're saying on, say, a revenue per employee basis are telling two slightly different things. You're beginning to see some good forward progress made, but I'm not sure that we can attribute all of the improvement in the government statistics to what's happened with AI.
And without maybe, spilling the secrets on what you guys are doing at your firm, but I was talking to somebody in the banking community on the technical side, but saying that right now banks are like, use whatever you need, models, go ahead, do it, everybody. At some point, there is a cost to that. And it's going to be banks, every industry is going to be a lot more discretionary.
So I think that there are two things, right? One is the power of the tool. The other is the spend, right? We've seen from countless businesses across the U.S. economy that their AI-related spend is up substantially this year. That is an issue in and of itself. In terms of the tools, yes, they're saying use these tools, try to figure out how to make your job not easier, but more effective. What I actually think we're going to see here is a more nuanced adoption of AI over time, where financial services firms use AI in a very specific way. And that's different from manufacturing firms. That's different from healthcare firms. And again, when you begin to specialize, that can actually help reduce the overall cost. So right now, everybody's throwing everything they have at this because it's so new. I do think we'll see it mature.
But David, is it a threat to the labor force, as Dario Amodei has talked about at Anthropic?
So it's interesting because I could give you countless examples of technological innovations over time that were perceived as threats to the labor force. It may be a threat to the labor force as it currently stands, but the one thing about these big transitions is that, yes, you destroy jobs on one end of the economy, but you create a whole bunch of jobs on the other end. And I think it's not about will AI replace our jobs. It's how can we adapt the way we do our jobs to maybe delegate some things to this technology and focus on things that require more critical thinking.
In the meantime, there's an incredible spend, right?
Yes.
Just look at SpaceX. And I know your bank, everybody was involved. So again, not going to be specific, but the equity raises, the debt raise, we've got SpaceX, like all the banks are now kind of shopping that debt raise. I mean, at some point, does it become a little silly? And when do we start to get nervous? Because it is going to be more discretionary, as you said, specific industries doing certain things. So when do we, I don't know, how do you kind of roll that into your outlook?
So I'd say from an academic perspective, right, Modigliani Miller tells us that it's not about the capital structure, it's about how you use it. So theoretically, we could issue a ton of debt, a ton of equity, and you would see the productivity gains accrue over time. Unfortunately, that's not the way the world actually works. And I think what's most interesting to me is when you look at what's happening in the market right now, investors seem to be differentiating between the companies that are writing the checks and the companies that are receiving the checks. Because at the end of the day, what everybody's going to care about is whether or not there's sufficient ROI on all of this to make it worth the spend. We're still, again, very early days there, but it's not lost on me that particularly as the credit markets have opened up to this AI financing trade, that's something that we need to keep a close eye on because as we've seen throughout cycles, right, leverage can be the thing that brings the whole house down.
Yeah.
Dare I say irrational exuberance?
Oh, it's a nice way to end it.
Is it?
Yeah.
30 seconds. Your major driving force when it comes to markets now as you look at things?
So I think
major narrative, yeah.
We're still in a world where we're pro-risk across our multi-asset portfolios, but we're really leaning into where we have fundamental support for the thesis. And so in the equity market, we want to see the earnings, right? We're not necessarily going to take a flyer on a company that's not generating profits. On the credit side, we're trying to diversify our sources of carry. So, it's not clear to me that spreads can tighten all that much further. So we want to have some consumer exposure through the securitized market, some corporate exposure through things like the high yield market. And if we get a little bit of price appreciation, great. If not, we're still earning a pretty healthy carry when all is said and done.
Great stuff. Thank you so much. Great way to get going on the Monday for us. David Lebovitz, he is multi-asset solutions global strategist at JPMorgan Asset Management. This is Bloomberg.
It's 2:21 on Wall Street. I'm Matt Piper. Traders are driving stocks down from the brink of record highs amid apparent progress in peace talks between Iran and the U.S. The S&P right now is down 0.2%. The Dow is up 0.4 or 204 points. The Nasdaq is down nearly 1%, losing 256 points at this hour. The 2-year yield is at 4.22. The 10-year is at 4.50. Oil has retreated. Brent is at $77 a barrel. WTI just moments ago is now at $75 a barrel. Bloomberg's dollar spot index is at 1218. As for stocks we're watching, shares of Getty Images are surging. Right now, they are up 93%. Guess why? AI. It's after the stock photo company announced a licensing deal with OpenAI. The images from Getty's library will now appear in search and discovery features of ChatGPT. Analysts were worried that artificial intelligence developers would poach their business. Well, are you looking for deals? The big retailers hold their major summer promotional events this week. Walmart's promotion kicks off today and runs through Sunday. Amazon holds its Prime Day event for members starting tomorrow and running through Friday. And Target's Circle Deal Days promotion also goes live tomorrow and also runs through Friday. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash.
All right, Matt, thank you so much. Carol Master, Tim Stanovic, live here at Bloomberg headquarters in New York City. Want to head back to geopolitics. Kier Starmer said he would step down as Britain's prime minister after suffering a precipitous fall from favor, paving the way, Tim, for Andy Burnham to succeed him. This was the story. I mean, to be fair, Bloomberg was all over it this morning.
Starmer's exit opens the door to Britain's fifth premier just since 2022. It's a jarring milestone for a political system which once prized itself on its stability. Here's Prime Minister Starmer speaking earlier outside of 10 Downing.
The question my party is asking now is whether I am best placed to lead us into the next general election. That is why I will resign as leader of the Labour Party.
Prime Minister Keir Starmer earlier today in London with nominations for successor opening next month, July 9th. Then any contest wrapped up by the end of Parliament's summer break. That happens on September 1st. He did say, Carol, he would remain in office until the process is done and, quote, ensure an orderly handover of power.
It's been a tough few years, certainly, for the United Kingdom. For the latest, we do head to London and to Therese Raphael, a member of the Bloomberg Opinion editorial board. Therese, for those who may not be following UK politics so closely, why is this happening now? What do we need to know, certainly, as an investing audience?
Yeah, well, I think the first thing that will strike people is just how often this seems to be happening in the UK. So this is the seventh change of power since we've had the Brexit referendum in 2016. It's happening now for a couple of reasons. There were a series of local elections around the country in May in which Nigel Farage's Reform UK did tremendously well. And it looked very likely that if there were a general election held, Labour would be out of power and Britain would be ruled not by one of the two major parties that have governed it throughout much of modern history, but by Reform UK. So that has set off alarm bells among Labour MPs who have also noted that Keir Starmer is a very, very unpopular leader. There's not been one major scandal. There has been the scandal around his former U.S. ambassador, Peter Mandelson, whose ties to Jeffrey Epstein were much deeper than Starmer had admitted knowing or knew. But there's not been one thing that really, destroyed Starmer's prime ministership in the way we saw with, say, the Tories, where you had a series of scandals that ended up resulting in Boris Johnson having to leave power. But the second thing that happened was the what we call a by-election, which is an election in a Manchester constituency called Makerfield last week, in which Andy Burnham, a Labour heavyweight, very popular politician, won resoundingly in the very constituency that Reform had swept to a clean victory in the council elections in May. And what that seemed to show Labour MPs is that here was a Labour politician capable of taking on Nigel Farage's Reform. And he's a very different Labour politician. He's in his 50s. He's very charismatic. He's able to tell a story about what he's done in Manchester as mayor. And he's been in politics a very long time. He served previous Labour prime ministers. He was an MP in the past. So the Makerfield victory for Andy Burnham made it very hard for Keir Starmer to argue that he should stay on, and his own cabinet seemed to have impressed on him that this just wasn't worth fighting, and he resigned this morning.
I mentioned a few dates, Therese. July 9th, September 1st, which is the end of Parliament's summer break. What is the timeline here for a new prime minister?
Normally, to bring in a new labor leader is an incredibly involved and long process. But this one looks like it's going to happen fairly quickly. I don't think that we see any labor candidates at the moment that who will stand up and try to challenge Andy Burnham. The most likely one was Wes Streeting, the former health secretary, but he also announced today that he wasn't going to quibble over small differences, and he was going to get behind Andy Burnham, and is probably hoping for quite a senior position in a Burnham cabinet. So Starmer has made it clear it would be before the end of the summer break. Parliament goes on break for the summer, which means but I think we're more likely to see it, in a matter of weeks, if not, certainly before the end of the summer. And the question for, I think, the Burnham camp is, do they try to capitalize on the current momentum and have a transition as quickly as possible, or do they take some time to work out who the leadership team is and what their positions are on a range of key issues?
Just a reminder that there's a lot of political instability or changes going on around the world, certainly in terms of what's going on in the UK. Therese, thank you so much. So appreciate it. Therese Raphael, she is a member of the Bloomberg Opinion editorial board, joining us from London. All right, from UK politics to the latest between the US and Iran. Bunch of headlines. I feel like, is it just a difficult situation, Tim, and this is just how something goes, or it does make me wonder, are there some real problems about this deal sticking longer term?
Well, that's the question for Jenny Welch. She's Bloomberg Economics chief geoeconomics analyst. She joins us from our Washington, D.C. news bureau. Some of the headlines that Carol mentioned: the U.S. issuing a 60-day license allowing Iran to sell oil on the international market. It gives Tehran an economic lifeline as the two adversaries continue talks for a permanent peace deal. Is 60 days enough for a permanent peace deal, Jenny?
We think that's quite ambitious, considering that prior rounds of negotiations took years to deal with some of these very contentious issues. And that was before, of course, the U.S. and Iran fought a major war, and Iran realized it has this major point of leverage over the Strait of Hormuz. All that being said, as you mentioned, negotiations over the weekend were off to a pretty rocky start, with the signing ceremony not moving forward as anticipated, with a threat for the Iranian delegation to walk out of talks following President Trump's online threat to attack Iran. They did remain in the room and noted that there was heavy progress made, which is a positive in terms of the peace talks. But we see the road ahead is quite bumpy and fraught with complications, not least of which are ongoing clashes in Lebanon.
Well, that's where I want to go, Jenny, because Israel seems, or the relationship between Israel and Lebanon and the activity coming from Israel seems to be a pretty big problem. I mean, could this undo this deal between the United States and Iran?
It has already been a sticking point in just the few days that we have lived since the MOU was signed. Iran has said that this is a red line for them. They've threatened to reclose the Strait of Hormuz. They've threatened to walk out of talks over these ongoing clashes. And it's also become a point of friction between Washington and Israel, with President Trump speaking publicly in much more critical ways about Prime Minister Netanyahu and Israel more broadly over its military campaign in Lebanon. And this is clearly something that Israel is not happy about, the fact that it was not party to these negotiations, and yet the deal that they have produced in the form of the MOU seeks to restrain their military campaign there.
Yeah, look, we don't know what the final deal will look like. We don't know what will be negotiated. But at this point, Jenny, what's the area of distinction between the JCPOA and what we've heard from the Trump administration?
Well, that's a great question. I think President Trump feels quite strongly about it. And to be honest, it's very hard to say at this point, because JCPOA, the 2015 nuclear deal that the Obama administration negotiated, had a lot of details on it in terms of what Iran's enrichment capability would be, how long these terms would last, the status of inspections and access by IAEA and other international inspectors to Iran. And so far, none of those details have been worked out. The MOU that was agreed to last week was sort of a roadmap for talks, and it really punted details on the nuclear file in particular to the 60 days of negotiations, where I think you will see there is quite a bit of daylight between the two sides. And again, an Iran that feels probably in many ways much more emboldened and in a stronger position than it was back in 2015.
All right. So, if you were a betting individual, I mean, are we likely to be still talking about the inability for this to be signed on the dotted line and be done and for these two nations to move on before the end of the year? I mean, I don't know. I'm trying to figure out how to think about a war that I think some thought would be overdone or done quickly. I think certainly the White House did. Certainly the president seemed to have. And yet here we are still talking about it, and it's almost the end of June.
I think there is a very high likelihood that talks break down or produce a deal that doesn't prove to be lasting for very long, in part because the two sides are so far apart, in part because distrust runs very high. I think there's limited certainty in Washington, for example, that even if Iran agrees to not possess or develop a nuclear weapon, that they may still pursue one in secret. And I think likewise, Iran feels that they've negotiated with the United States before and have been attacked twice by the Trump administration in the midst of negotiations. And then again, there's the Lebanon question, the Israel question, not party to these talks, but very much a factor here, and that I think could prove a spoiler in negotiations, even on top of all the hurdles we've talked about. So I would say we're rather pessimistic on the odds of a lasting peace deal coming out of this. And then there's, of course, the question for companies that even if there is some semblance of a deal, do they feel confident enough that the Strait of Hormuz is safe to go through again?
Well, that leads me to my last question here, Jenny, and just got about a minute or so here left. Are we better off or worse off or the same since this war between the U.S. and Iran began?
I would say we are currently better off than we were on March 1st and 2nd when the war was at its most intense stages and traffic was fully paralyzed or on the way to being fully paralyzed in the Strait of Hormuz. But we are very far from where we were before the war began, even if you just look at traffic in the Strait of Hormuz as one example.
Keeping us busy, that's for sure. And markets, it's interesting, though, how markets seem to look through this, but
well, look at oil prices today.
Yeah.
Even after what happened this weekend, oil today is still down 3.3% for Brent, WTI down 2.7%. So
yeah. But again, Jenny, we know that all of this could turn around in a heartbeat on a different headline. Hey, listen, we always appreciate checking in with you. Jennifer Welch, she is Bloomberg Economics Chief Geoeconomics Analyst, joining us from the Bloomberg Washington News DC Bureau. All right, folks, we are continuing on Bloomberg Businessweek Daily. And when we come back, we get a Bloomberg exclusive, a read, a reveal on the credit health of consumers.
Looking forward to that. In the meantime, the S&P 500 down 0.3%. The NASDAQ under pressure, down a full percentage point. This is Bloomberg Businessweek Daily.
It is 2:40 on Wall Street. I'm Matt Piper. We check the markets for you all day long here at Bloomberg. Stocks are drifting near their records in mixed trading. The S&P has slipped 0.3% and pulled 1.7% below its all-time high that was set earlier this month. As for the Dow, that has added 0.3%. The NASDAQ has fallen 1% today, lower by 280 points. Oil prices fell, dropping closer to where they were before the war with Iran began. Brent is at $77 a barrel. WTI is at $74 a barrel. The lower oil prices have not pulled Treasury yields lower, though. The 2-year yield is at 4.22. The 10-year sits at 4.50. As for stocks we are watching, SpaceX shares are slipping for a third straight day after the company said it's selling investment-grade bonds for the first time to fund its artificial intelligence ambitions. Shares right now down 10% at $165. Intel, INTC on the terminal. Shares of the tech giant are up 5%. The stock rallied at the end of last week after President Trump announced that Apple agreed to work with it to design and build chips in the U.S. Apple, by the way, right now is up 0.3% or $298. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash.
All right, Matt, thanks so much. Well, it was just last week that we got a read on the U.S. consumer when retail sales data from May showed that U.S. consumers increased spending in the month across a broad range of retailers, and that was despite higher gasoline prices.
11 of 13 categories posted increases. Motor vehicle sales rebounding by 1.2%. Spending at online retailers rising rising for a fifth straight month. We could go on, but it's not the only way to measure consumers.
No, and our next guest has a great read on consumer credit resilience. For more in a Bloomberg exclusive, we head to the Bloomberg News San Francisco News Bureau and to Silvio Tavares. He is president and CEO at VantageScore, joining us. Silvio, it is great to have you here, and we appreciate the exclusive. We did just talk about consumers still shopping in May. That is one, as Tim mentioned, one read on how consumers are doing. But tell us about this latest edition of the credit gauge from your company.
Great to be with you, Carol and Tim, again. And the data from our VantageScore credit gauge, which has been made exclusively available to Bloomberg, shows a very consistent pattern to what we saw on the consumer spending side. Through the end of May, consumer delinquencies overall early stage were at 0.89%. A year ago, they were substantially higher at 1%. So the overall consumer credit health of the American consumer is good and stable. And it's surprising, given the fact that we see sustained inflation, sustained high interest rates, consumers were good. And we measure that by the average VantageScore as well. Through the end of May, that was 701, a low score is 300, the best score is 850. So overall, the consumers healthy through the end of May.
Silvio, why is that surprising to you? I mean, we're certainly getting it from other data, but you said just now that, you rattled off all the data. You said it's surprising the consumer is healthy, surprising the consumer is resilient. Why does that surprise you?
Well, the reality is if you look at the overall macroeconomic stage, the reality is inflation is sustained. Interest rates are high. Housing costs are high. And so what we see in the face of all these challenges is the consumer remaining resilient and also rather disciplined. If you look at actually overall credit utilization is down on a year-over-year basis. A year ago is over 50%. It's actually below that now at 49%. So overall, consumers are disciplined and healthy. And if you look at the way banks are looking at the consumer, we also saw an increase in consumer lending. I'll give you an example, credit cards. The percentage of consumers with new credit card accounts through the end of May was at 3.6%. A year ago, it was at 3.3%. In the personal loan category, the number of consumers with a new personal loan account was at 3.4%. A year ago, it was at 2.75%. So really on a broad basis, as we look through the end of May, the consumer is actually very healthy and disciplined in the light of these economic headwinds.
Silvio, when do we know that? So it sounds like people are tapping more personal loans and more credit on credit cards or access. So when does that turn into actually a worrisome sign that people are tapping more borrowing, if you will, in different ways?
Well, what may be behind that personal loan increase number is the fact that consumers have sticker shock on their credit card interest rates. They're very high, and some of them are rationally refinancing their consumer debt by entering into personal loans. Now, to answer your question directly, one of the great things to do is look back at the past as an indicator for the future. And what we saw in 2008, before the great financial crisis, is consumers dramatically increasing the amount of credit cards they had and then immediately going delinquent on those loans. We are not seeing that now. Instead, what we're seeing is the delinquency rates stabilizing to lowering on a year-over-year basis, and consumers doing everything they can to have dry powder available in their credit lines, but not utilizing them. And so that's what we see in the credit utilization rate. So again, overall, a rational consumer, a healthy consumer, and that is great news for the overall economy.
We're speaking to Silvio Tavares, the CEO and president of VantageScore, joining us from San Francisco. Silvio, for people who aren't familiar with VantageScore and maybe sort of just understand their own credit scores, but not an amalgamation of three different credit rating firms, explain how your data is different and how you try to offer a different view of the consumer and what data you use.
Yes, well, that's one of the unique things about VantageScore. We are the nation's leading credit scoring company. As you referenced, we are an independent company, but our owners are the three national credit bureaus, TransUnion, Experian, and Equifax. And as a result, we have unique and unparalleled access to consumer credit data. Sometimes the consumer says in a poll something different than the way they actually behave. We actually look at the actual credit data. And so all of the statistics I was sharing with you, they're based on actual consumer behavior. And that gives us a high level of confidence in the VantageScore credit gauge that we publish every single month. And on Wednesday, the full analysis will be published. And I'm sharing those insights with you early today. It's really exciting, though, to see the stabilization of the consumer. That being said, we are looking at mortgage. That's a big part of the economy. The good news in this analysis is that the percentage of consumers with new mortgages was at 0.35%. That matches the highest level that we've had this year. And so the other key thing is, despite higher interest rates, consumers are actually wading back into the market and getting new mortgages. And we're a big part of that. We were recently accepted for mortgage use by the major mortgage government-sponsored entities, Fannie Mae and Freddie Mac. Really exciting to see largest mortgage lenders like PennyMac, Rocket Mortgage, United Wholesale Mortgage, all those companies using VantageScore to enable more access to mortgages for more credit-worthy Americans.
Yeah, I remember Bill Pulte mentioning this a little under a year ago in a way to get Americans to increase home ownership. Is it going to work?
It's happening now. We're seeing the largest mortgage lenders using VantageScore to qualify and pre-qualify consumers and then underwriting those mortgages. There are now over 100 mortgage lenders that have signed up to use VantageScore for mortgages. It's really, really exciting. We anticipate that over the next 12 months, two things will happen. Millions of credit-worthy consumers that are going to get their first chance at home ownership. We estimate that to be about $1 trillion in incremental mortgages. But the other key thing is our mortgage credit score is substantially more cost effective for lenders. And so the mortgage lenders are going to save about $1 billion over the next 12 months. So it's really hard to typically deliver that incremental mortgage activity at a lower cost, but we're doing it. And we're very, very excited for both the mortgage lenders and the American consumer.
All right, we're going to leave it on that note. Hey, listen, thank you so much. We love any kind of reads on consumers and what it tells us maybe more broadly about the economy. We know how important the consumer is to economic growth here in the United States. Silvio, thank you so much. Silvio Tavares, he's president and CEO of VantageScore, joining us, of course, from our Bloomberg News San Francisco bureau.
A little more than an hour away from the close of equity trading here. Down 0.3% on the S&P 500. NASDAQ Composite, those big tech names, those mega cap tech names under pressure today. Down, Carol, by 1.1%.
Yeah, kind of an interesting trade here this week. I'm thinking about what's coming at us. We're going to get more reads on inflation, so that'll be important. Keeping an eye on that. But right now it feels a little quiet.
All right. Don't ever say that, but
I just jinxed us.
This is Bloomberg Businessweek Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we are getting ready for the last hour of trade on this Monday. Carol Masser, Tim Stenovec, live here at Bloomberg headquarters in New York City. Quick check on the trade for you if you're just tuning in or listening in. S&P 500 just down about 33 points, down about 0.4 percentage point, 74.67. Dow Jones Industrial Average up more than 72 points, a gain of about 0.25%. NASDAQ 100, a little bit of the outperformer or underperformer, I guess I should say, on a percentage basis, down almost half a percentage point, down 145 points at 30,261. I didn't even look at small caps, which I'm always curious about.
In the meantime, while Carol looks at small caps, I'm looking at communication services, consumer discretionary, consumer staples, and information technology. Just go ahead and call it the Mag 7 that are under pressure today. In the S&P 500, real estate, utilities, and energy are in the green.
All right. Russell, actually up today. It was up as much as 1.2%, still up about 0.9%, so up 25 points. So some outperformance there on that one.
Under pressure today, oil down 3.3% for Brent. WTI down 2.6%, $74 a barrel roughly for WTI. Brent at $78 a barrel.
Where were we before the war?
60s.
60s.
Yeah.
Okay, so better than we were, but still not quite there. I'm Carol Master along with Tim Stanovic. Let's get to some stocks on the move. With us is Bloomberg News cross-asset reporter Denitsa Sekova.
Perfect.
Thank you.
Never been back.
We actually just got schooled on the right way to say it.
It wasn't from me. It was from Tim. He started the campaign. He was like, "This is how your name is pronounced." No,
but I didn't tell you that.
He's very sweet.
No,
I
didn't tell you that. No, you were doing it. Here's the real story, because I'm not like mansplaining somebody's name, just to make sure everybody knows.
No, Denitsa, here's actually how you say your name.
Her name, and I said I wrote her an email, and I said I've been saying it wrong for 3 years at this point.
No, you've been great.
Okay, well anyway.
I use both. You're all amazing.
We are happy to have you, Denitsa.
Okay. All right. Well, all right. So let's get to some stocks on the move. Alphabet. So there's one of the big Mag 7s.
Alphabet, pretty rough day for Alphabet.
Yeah.
We've been talking about AI war when it comes to Taiwan AI war, but there is no clear show than what we're seeing in Alphabet today. The stock fell as much as 7.2%, the biggest intraday drop since February. The ticker, of course, is Google. The big move today is Google DeepMind Vice President John Jumper leaving. The announcement came over the weekend. He's going to Anthropic. He won the 2024 Nobel Prize in Chemistry for his work in artificial intelligence. Clearly very important member of the team. He was a very important member of the AI coding development team. And this is the second big departure in a very short amount of time. We saw Noam Shazir also depart, but going to OpenAI. And this
the talent war, man.
Yeah, the talent war is crazy. And we hear that Google is behind on those AI coding tools. And then you go to OpenAI and Anthropic, and they're really, really ramping up. That's kind of the next wave. And you can see Google is down so much. It's up only 10% this year.
What?
I don't know. We went to the Sphere last week. We saw The Wizard of Oz.
We did.
The new AI version that is cut down from a longer movie to just about a little over an hour. And at the end, the credits showed Google's huge team that worked on the AI for this, James Dolan version of The Wizard of Oz.
Can we just say the credit roll after that alone was just amazing, right?
And those are all the people that worked on the new version of the movie.
The new version. But how much technology was obviously involved in making that happen, right? It was kind of wild. Like we were looking at just the different entities that were involved.
Well, there's also just the interesting sort of corporate story about this, which is that it's an MGM movie, but it's now owned by Warner Brothers Discovery. So David Zaslav was mentioned too in the credits. But, I think we were the only ones in the whole Sphere who cared about that.
Right. Everybody else was
that
trying to take pictures and
like
get the credits off, and we're like, oh my god, oh my god.
What about AI?
It's exactly. All right, where do you want to go next?
SpaceX, which is also AI story. Everything is AI story. SpaceX is down for third straight day. Of course, we have the volatility after IPO. This is pretty normal. But what we have here is the company selling investment grade bonds. We reported this earlier last week, but clearly that adds up to some of the volatility. The stock keeps falling. Ticker is SPCX. It fell as much as 12% on Monday. Kind of got worse during the day. And then don't forget, on Wednesday and Thursday we get another 8% drop, still significantly above that IPO price. But we're talking about $20 billion from first bond offering. And knowing Elon Musk and the whole ecosystem of companies, he said, he likes to borrow and wants to do this big investment in AI.
They just raised $85 billion when you throw in.
That AI stuff is expensive.
It's expensive.
I mean, we've all talked about, right, that you're going to have to tap both debt and and equity markets, and so that's exactly what you're seeing. But it just depends where this all goes. Just got about 30 seconds. What do you want? Last one.
Another AI story. Getty Images soared as much as 145%, now up about 80%. Ticker is GETY. They have a new licensing deal with OpenAI. They've been kind of pushing back against AI for some time. Now they have this licensing deal. The stock was down 55% before this. What we know is that images from its library will appear in the search and discovery feature of ChatGPT. Much more to be disclosed, but definitely an interesting trend.
I love that story.
I do too, but I mean, what's an AI version of an actual image going to look like?
I don't know.
Yeah.
I don't know.
The
ownership of it, right? Like, I don't know. Anyway. That is the times we're living in. Denitsa, thank you so much. Check out our Stock Movers podcast, 5-minute episodes, big winners and losers. The Open coming your way right here on Bloomberg Television.